Price hits the supply zone, a short trade is triggered, boom, price turns down, trade gets closed at the demand zone. A risk-reward ratio of 10-1, locked in. Looks super easy, right? Supply and demand, perfect zones, perfect trades. Trading is so easy. But let's be honest, how often were you actually in when the market turned that perfectly? Today, let's take a closer look. Are supply and demand zones really that great, or is there something that works even better? Let's get started. Every trader knows the basic idea. We enter in a demand zone. That's where the buyers are and the price is relatively cheap. In a supply zone, we exit or go short. Sellers dominate and the level is considered expensive. But in practice, it's often very different. How many times have you seen the price never even touch your demand zone and suddenly take off without you? And which support zone is the right one to enter? When several are open? The nearest, because it's close? Or the farthest, because it offers the best risk reward? In hindsight, every entry looks perfect, but can you hit the same setup live? Sure, you can check volume profiles and measure POCs, but the success rate still stays limited. The market is always right. If it doesn't need cheaper gas, it won't stop to fill up. It just drives off without us. Wouldn't it be better to always be in the market? Of course it would. But how is that even possible? We'll get to that in a moment, but first, let's have a little reality check. In 100 trending phases, the price only tapped into a zone 18 times and ignored it 82 times. We would have missed the trade 82 times. That can be really frustrating. You're sitting at your screen, the price starts moving, your heart rate goes up, you're ready to go, the price comes close to the zone, and then it doesn't. It just takes off and you're left behind. Tight stops are great, but a setup without execution doesn't make you any money. The alternative. Okay, so how can we do it better? Everything's marked perfectly, and still, no trade. That's exactly how it feels when the bus drives right past you and you're left standing at the stop. I want to be on that bus the moment it starts moving. I need a setup that doesn't wait for hidden bus stops, but one that lets me jump on immediately the moment the engine starts. That's exactly where the 1-2-3 pattern comes in. It lets me enter the trend as soon as it shows strength and keeps my risk clearly defined. Short summary. We leverage the natural rhythm of a trend. Higher highs and higher lows in an uptrend, and lower lows and lower highs in a downtrend. The 1-2-3 pattern kicks in exactly when the market signals, I want to keep going. What does 1-2-3 actually mean? Point 1. Reversal low. The market prints a clear final low at the end of a downtrend. This is the first signal of a possible trend reversal. Point 2. Reaction high. A strong counter move pushes the price upward, creating a local high. This high is well above point 1, but doesn't break any major resistance. It becomes the key reference level for the upcoming entry. Point 3. Higher low. Price pulls back again, but turns above point 1 and forms a higher low. This shows that buyers step in before the previous low is reached. Trigger. If the price then breaks above point 2, it confirms the higher low, and that's where we place our buy stop order. In a downtrend, we simply reverse the structure. Point 1 forms a high, for example, the last high of the previous uptrend. Point 2 is a correction low, the first downward move after point 1. Point 3 is a lower high. This lower high stays below point 3, otherwise it would be a higher high. The entry happens when price breaks below point 2 using a sell stop. How to trade the pattern? Step 1. Set your entry. Place a buy stop order just a few ticks above point 2. If it doesn't get triggered, you stay out of the market. Simple as that. Step 2. Place your stop. The initial stop goes below point 3. In high volatility, add a buffer, maybe around 0.5 ATR. Step 3. Manage the trade. Once the price forms a new high, move your stop to just below the new higher low. That way you ride the trend and only give back as little as necessary. Step 4. Plan your partial profits. After about plus 2R, you can lock in 50% of the position and set the rest to break even. That's exactly how Strategy 1 works too, with additional filters and more profit targets. Why this setup is so powerful? Fill rate instead of hope rate. You're not waiting for a deep touch of the demand zone. You enter as soon as momentum proves itself, which according to the backtest gets you filled almost 3 times more often. Clear structure, clear risk. Higher high, higher low. Higher high is easy to spot. The stop goes logically behind the last higher low, no guesswork. Scalable to any time frame. from a 1-minute scalp to a weekly swing. This pattern is based purely on price action and structure. No indicator lag. Strong risk reward even with a wider stop. Even if your stop is bigger than in a perfect demand zone reaction, the ratio stays strong because you're riding the trend and catching the full move. Conclusion and comparison. The core question is, do you want perfect risk-reward ratios on paper, or do you want to be actually in the market when it starts moving? Let's start with fill rate. In supply and demand pullbacks, the zone often isn't even reached during a trend, so the fill rate is low. With the 1-2-3 pattern, we enter right after momentum shows itself, so the fill rate is much higher. Next, stop distance. Supply and demand allows for very tight stops directly above or below the zone. The 1-2-3 entry places the stop slightly below the pullback low. It's a bit wider, but still clearly defined. Third comparison. The theoretical risk-reward ratio. A perfect zone reaction can easily give you CRVs of 1-3, sometimes even 1-5. Sometimes even much more. The 1-2-3 pattern delivers a realistic 1-2, sometimes 1-3, still very attractive but much more frequent. Next point, trade frequency. Traders who wait for demand touches often spend a lot of time on the sidelines, so frequency is low. The 1-2-3 setup offers many more entry opportunities per trend, which means high frequency. Let's move to error rate, meaning fake outs or stop hunting. Supply and demand setups give you fewer triggers, and when the trade comes, it's usually clean so the error rate stays low. The 1-2-3 pattern generates more trades, but around 20% of them are false entries where the stop gets hit. Now let's talk about complexity. Drawing zones is often subjective. 2 traders, 3 demand boxes. The 1-2-3 pattern follows a clear structure of higher highs and higher lows. Easy to spot, easy to verify. And finally, the stress factor. Waiting for supply and demand often leads to frustration because price just runs away. With the 1-2-3 pattern, you're in the market more often, which means more activity but much less FOMO. Supply and demand gives you tight stops, but often leaves you waiting on the platform. The 1-2-3 pattern gets you on board with a slightly wider stop but brings you to your target much more often. Pro tip: use demand zones as a context filter. If price is trading above the zone, look for 1-2-3 longs. If it's trading below, look for 1-2-3 shorts. That way you combine the best of both worlds. Test both approaches in a demo account and post your results in the comments. If this video helps you, leave a like and subscribe to the channel.